Here at Index Fund Advisors, we want to change the way the world invests. People need to turn away from short-term speculation and focus instead on long-term investment returns. But there's more to those returns than just price appreciation. They also include stock dividends and interest on bonds. And yet, with just 2 exceptions, all of the world's major market indices are price-only indices. IFA founder Mark Hebner has launched a petition calling on the industry and the financial media to make total return indices, including dividends, the default. And one of the first people to sign the petition was Pankaj Agrawal. He's a professor of finance at Maine Business School. He used to work in quantitative research and portfolio management in the investment industry. Dr. Agrawal feels so strongly that investors should be shown total returns, or correct returns as he calls them, that he built an iPhone app called the Total Returns app. The app shows the total returns, including dividends, for mutual funds, ETFs, and individual stocks.
So if you put in a ticker for, let's say, Barclays Bank, it will instantly produce 2 lines. The first line is the total return line, and the second one is just so that people can check with other sites, is the price only line.
So how big a deal are dividends? How much of a difference do they make to total equity returns? The answer is a very substantial one.
About 30 to 40% of the terminal value that arises from holding a stock that pays dividends is arising out of the dividends. So people don't normally think that, oh, the dividends are 1 to 5%, so the difference will be 5% or maybe 10%. So no, absolutely not the case, because it's the compounding and the addition of the increment. Like Einstein, his report says, the greatest force on earth is the power of compounding. And like one famous study. I mean, Jeremy Siegel, who's Wharton professor, his book, Stocks for the Long Run. It clearly shows that if you take a $1 and you invested it 100 years back, literally, 1924 now, that would be $712 with no dividends. And if you had dividends included in it, that number would be some mind-boggling, like I think $12,000 or something like that.
All this begs a question. Why don't the investment industry and the financial media display total returns as a matter of course? Dr. Agrawal believes there are 3 main reasons.
The simplest answer is that it's tedious to produce it. And because I have literally done that, I literally rolled up my sleeves. So if you actually look at these websites, if you go to, let's say, a website like Big Charts, which is a very good website, clean website, you can actually click on a button and it'll show the dividend events. The only thing is they show the dividends, they have the data, they don't add it, and then they don't recompound it. So the simple thing is it's tedious, and it's just messy programming. It's not even complicated programming. It's just tedious and messy. And so that's reason number 1. Reason number 2 is a legacy factor, I think. Is if you just roll back to 1970s, 1960s, the quotations in the Financial Times or the New York Times, Wall Street Journal, is this whole thing was geared towards trading. And when you're trading, you're putting, 100 pounds and you're looking for 110 pounds, If you get any dividends, you think there are a few pennies and who knows, and you're not even there after 6 months. So to collect the next set of dividends. So it's basically very trading oriented. I think the market microstructure is geared towards trading, and that's a legacy factor. So the third reason, which is sort of on the darker side, is that a price path that includes dividends has much less volatility. Now, guess what that does? If an investor, she's presented with an asset which has very little volatility and it's going northeast at 45 degrees, she has no reason to trade it. She's like, okay, this is nice. And So, you can complete that thought. Is basically, I mean, this whole industry is based on commissions.
As I mentioned, Dr. Agrawal is supporting IFA's campaign to encourage global financial media companies to report total return index values. The change, he said, would in fact be very easy to make, and it would have a hugely positive impact.
One can laugh at it, but this is almost like the mid 70s when the EPA said that cars have to have catalytic converters, and it totally changed the industry. It seriously changed the industry.
Remember, price returns are only partial returns. It's total returns that really matter. So why don't you sign our petition? Just click on the petition link at the top of the IFA website or go to ifa.com/petition. It will only take a few moments, and you really will be helping us to move the industry and the financial media in the right direction.